And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Okay. So, a lot to talk about today. What I'm looking at right now is the discouraged worker report. And it's the highest, I think, ever. I just started to look at it. If you can see it on my chart or on my computer here, I put it up for you. Look at that. That's unbelievable. But again, what's going on in the market? Let's talk about that first, then we'll get to that a little bit later. But everyone's waiting, okay? Everyone's waiting for this report. Housing starts, building permits, new residential construction, pending home sales, jobless claims, PPI, on and on and on, which doesn't mean squat, because those are fundamentals, and fundamentals can be manipulated. What you can't manipulate is just the truth. And that's why the truth is the liquidity. Because right now, we don't have low yields anymore. And that's a real problem. And when you don't have low yields, you got a big problem with the stock market. When you don't have easy credit, you got a big problem with the market. If you don't have low funding costs, we don't have any of that right now. That's what they should be worried about. Never mind these reports. When you look at these reports, they're in the rearview mirror, going backwards. Who the hell cares about those? And all they do is they'll either do a pop to the upside or a pop to the downside. They don't give you any direction move at all. So you can get a pop, but they don't fuel the move in the stock market. They don't fuel the direction. But all the weight, when you hear the jibber jabbers talking on TV, oh, these reports, sure, they love them because they can manipulate them, because they're fundamentals, and they can create nice stories to try to move the market. But the only thing that can move the market and keep moving it, again, is low liquidity. We have low yields. So we don't have low yields right now, and that's a real problem. And our credit, right now it's hard to get credit, and the funding cost is high. That's not good. So, but the question was today, my subject today was about the market crash. What has caused all these crashes in the last 100 years? If you had to put your finger on it, if you take every major crash, 1929, 73, 87, 2000, 2008, 2020, every one of those crashes were triggered by the same thing. Liquidity breaking, not fundamentals, not housing starts, not new residential construction, not pending home sales. No, they didn't create any crash. What creates the crash is when you have a liquidity event. And we've had them every one of those years, a liquidity event, which means that the yields are no longer low. That's the big problem. When you go to borrow money, you want to see low yields. You want to see easy credit. You want to see low funding costs. We don't have that. And every one of those years, 29, 73, 87, 2000, 2008, 2020, all triggered by liquidity not behaving. And that's what we have right now. So while everybody's waiting for this report, the jibber jabbers are talking about this report, there's no weight in those reports. So it all comes down to the market direction. And the core truth is the market moves higher when you have the liquidity behaving itself and everything's low. That's what you need, okay? If where we are now is with high yields, that's not good news. Now, as I said, what caused every crash was a liquidity event. Now, the mother lode of a crash setup, okay, is oil. That's right, oil. It's always been that. Now, most people don't remember what happened back in 1973. And when you have oil spiking above $110 to 130, but just above 110, this is a classic stagflation trigger, which means you got the economy stalling, cost ripping to the upside. Another problem, M2 money supply is flat. Now, M2 money supply just means when, like right now, we have weak checking deposits. We have weak savings deposits at the banks. We have weak the small deposits are very weak. Retail money markets, very weak. So this means no fuel in the system and tight liquidity conditions, high yields, tight credit, high funding costs. Bam! Exactly what happened. What's going on now is exactly what drove us to a 1973 crash and 2008. So now what creates the stagflation part of it is, again, the liquidity crisis. When oil spikes and the liquidity, instead of low yields, are high yields. And then you have no rate cuts, higher inflation expectations, higher yields, lower liquidity, slowing economy, rising prices, you're screwed. And this is the exact setup, as I said, that broke the markets in 1973 and 2008, and that's where we are right now. We're heading in that same direction. Now, can the plunger team stop this? Okay, it can stall it, that's for sure, and how they do it is really simple. Now, everybody misunderstands the plunger team. They think the plunger team just goes in and stops everything. It doesn't work that way. The plunger team, the President's Working Group on Financial Markets, when we have some negative pre-market or during the day gets negative, and what happens is the president will call his team together. And they'll make the decision to pull the trigger. Now, what does that mean? They will coordinate an effort between the Fed primary dealers, JP Morgan, Goldman Sachs, Morgan Stanley, Citi, and the futures desk. And they will instruct the arbitrage players. Now, who makes this call is the President's Working Group, but the President, he makes this call. He tells the Fed, get your primary dealers, JP Morgan, Goldman Sachs, Morgan Stanley, Citi, get them aboard and get them purchasing, have the arbitrage players start purchasing stocks and treasury. That starts the cooling down, okay? And that's how, and it's all computerized. They have a robotic, automated trading system that controls the largest arbitrage players in the country, and they buy all kinds of stock to stop the market from crashing. So yes, the plunger team will first come in to try to stop this, okay? And that will, but it's temporary. Nobody's bigger than the market. And when you have yields that keep running like we do now, and especially because of the oil prices, he's got to get these oil prices back to $75. That's where oil's got to go, $75. And if he doesn't get there quick, he'll lose the midterms, and we'll be stuck with fighting over, impeaching him again. That's what the worst thing that could happen right now in politics is if he loses the midterm, and he'll lose it if he can't get this oil, because people only care about one thing. They don't know even where Iran is on a map. All they know when they pull up to the gas station, even Marta, she said to me last night, I just paid $70 for gasoline. Okay, so that's what people remember. They sit down, they have food on the table. They bring in a bag of groceries, and they spent $250, and there's only one bag of groceries. That's what they remember. So that's a tough deal. But let's get to the discouraged workers, because that also ties into all this. Nobody wants to talk about the discouraged workers, okay? And all I can tell you right now, if you don't know how to short, you're going to miss a big opportunity. Right now, you're going to miss a big opportunity in shorting right now a lot of different stocks, but especially the miners. And we just started out shorting them. And the setup is to continue to short them. And it looks like the miners will continue to drop. But anyways, but now you take the discouraged workers at an all-time high when you got liquidity, meaning high yields, hard credit, high funding costs. At the same time, discouraged workers. It means that the labor market is worse than the unemployment rate shows. They've been lying to us. They've been manipulating, just like they manipulate the market. They manipulate the market with the plunger team. They manipulate the market with fundamentals. So the problem is, discouraged workers hit an all-time high. That means that bad for earnings, bad for demand, and that's bad for stocks. So even if the indexes, like the S&P, are still high, it doesn't matter. This is not good. So the real economy is weakening. We saw that with the GDP. The GDP dropped from 4%, I think it was, down to like 0.25%, something crazy. That's not good. Now, with record high discouraged workers, that signals the stock market and the economy is having problems. With discouraged workers, it actually means that there are people who want a job, but stop looking because they believe none are available, or they believe the ones that are available, they can make more money on unemployment. And so they're counted as outside the labor force. They don't even count them. So that really, so the headline unemployment rate hides these discouraged workers. They treat them as if they're nowhere. They don't even put them on paper. They're nowhere. So when you have discouraged workers spike, that means you got weak job creation. So how can they say how great things are, that jobs are strong? They're lying through their teeth. There's falling confidence in the market, the labor market. We see it every day. Households are losing their economic footing. Everybody knows that. So this is a problem. A slowdown that is deeper than the unemployment rate shows. They got to stop doing this. They got to stop masking. This is what Biden did. You can't keep doing this. This is consistent. This is consistent with broader labor market cooling trends. Now, how this hits the stock market is what we're concerned about. Now think about this, a lower consumption, lower earnings. So the U.S. economy's consumption is driven, right? The economy is consumption driven. Our whole economy is. Now, if people stop looking for work, they stop earning. If they stop earning, they stop spending. Corporate earnings fall, and stock valuations follow. This is exactly why weakening employment is historically tied to recessions and stagflation. Now, market breadth narrows when the labor weakens. And institutions, the big money, are rotating. They're rotating out of cyclical sectors like retail. We've been shorting the retail, industrial, consumer discretionary. We've been shorting these. And now we stayed out of staples. We stayed out of healthcare and utilities because those aren't working either. The only thing that's really working is oil right now. And when they tell you to go into defensive like utilities and staples, it just doesn't work. In fact, let me see if I can put this up here. We had one of the utility stocks that we've been trading a lot, ES, that's even rolling over. So right now, let me get down to the cyclicals. Okay, industrials. Honeywell was a big winner for us. That's still, now it's rolling over. We're getting ready to short it. FedEx was a big winner. It's rolling over. Materials, that's rolling over. Okay, Newmont, we have a short on Newmont. That's rolling over. Airlines are rolling over. ALK, we used to be long that. Now we're short ALK. We're short LUV. We're short all the airlines. Transportation, we did really well with the railroads, but now we're just getting ready to short UNP. We were long UNPs in February. So again, you got to follow the liquidity, and you'll always be on the right side to trade, okay? Not the jibber jabbers. We'll help you with that. philsgang.com.
Are you nuts?